Welcome to the BD Daily Finance News Podcast, your daily briefing on finance and investing. I'm your host. In the next 6 minutes, oil above 100, a headline-grabbing AI-chip IPO, bond traders watching Treasury borrowing plans, and crypto traders donating money to the liquidation gods.
And I'm your guest. Today's theme is, everything is expensive, and also everything is trying to sell you shares. If you're listening while checking your portfolio, please keep both hands inside the emotional roller coaster.
First story, oil. Bloomberg flagged sharp swings on signs of heightened tensions in the Strait of Hormuz, with talk of the U.S. guiding stranded ships out of the waterway. The key point for markets is simple. Hormuz is a choke point, so even the hint of disrupted flows adds a risk premium fast.
So oil is basically doing parkour over my budget again. If crude is above $100 a barrel, does that mean my next grocery run costs the same as a minor home renovation?
Not one for one, but the chain is real. Think of oil like the delivery fee for the entire economy. Shipping, plastics, fertilizer inputs, airline fuel. When the market prices in supply risk, businesses hedge and pass through costs with a lag. For households, the fastest hit is gasoline and flights. The slower hit is, why is everything $2 more?
Actionable question. Do normal people hedge this, or do we just cry into our loyalty points? Because I'm not buying an oil tanker. My HOA would complain.
Hedging doesn't have to mean trading futures. 3 practical moves. 1. Review your commute and subscription driving. Small reductions matter when prices spike. 2. Keep an emergency buffer so a fuel shock doesn't become credit card debt. 3. If you invest, avoid making a one-week oil call. Instead, check whether your portfolio is overly concentrated in industries that get crushed by energy spikes, like airlines and some consumer discretionary names.
Okay, story 2. The AI chipmaker Cerebras. CNBC says they're targeting a $3.5 billion raise, and we've got headlines tossing around valuations in the mid-20s billions. Are we doing AI is the new oil, or AI is the new .com? Because I need to know which costume to wear.
Here's the clean framing. An IPO like this is a temperature check on risk appetite. Investors are willing to fund capital-intensive AI infrastructure again. But valuation is not a trophy. It's a set of expectations. If you pay a premium, the company has to deliver growth, margins, and durability, especially in a market where competition and pricing pressure can show up quickly.
I disagree a little. People hear AI chip demand surges and immediately think it's a guaranteed money printer. It's not. It's like buying a gym membership and assuming you got abs. You still have to show up, and the treadmill still hates you.
Fair pushback, and I'll reverse my emphasis. The opportunity is real, but the path is narrow. For everyday investors, the actionable move is not chase the IPO. It's decide your AI exposure through diversified vehicles, broad index funds, or a measured tech allocation, then set rules. For example, no single story stock above a small percentage of your portfolio, and no buying just because it's trending.
Story 3. Bonds. Bloomberg says traders are watching Treasury refunding, Fed speakers, and jobs data. Translation: the government is about to announce how much it needs to borrow. The Fed is about to talk, and everyone is about to pretend they can predict payrolls.
Exactly. Treasury refunding matters because supply affects yields. Imagine a concert. If the venue suddenly releases a lot more tickets, prices can drop. In bonds, price down means yield up. Higher yields ripple into mortgage rates, auto loans, and the discount rate used to value stocks, especially growth stocks.
So if yields jump, my refinancing dream dies again. Cool. Love that for me. What's the grown-up move here, besides yelling at my phone?
2 moves. If you're carrying variable rate debt, prioritize paying that down. Guaranteed return, lower stress. If you're investing, check your time horizon. Short-term cash needs belong in safer instruments, while long-term goals can tolerate duration and equity volatility. And don't forget, when yields rise, new bond buyers often get better income. Pain now can become opportunity later.
Crypto. CoinDesk says crypto bears got it wrong again, about $300 million in liquidations. That's a lot of forced, I was totally going to close that position anyway.
Liquidations are what happens when leverage meets volatility. It's like using a step stool to reach a top shelf. Fine until the floor moves. With jobs data and macro headlines ahead, crypto can react like a high beta asset. It amplifies risk-on and risk-off moves. Actionable rule: if you can't survive a 20% swing, your position size is too big, or you shouldn't be using leverage at all.
Recap for the people. Oil risk can sneak into your budget. IPO headlines are not a retirement plan. Bond supply can move your real-life rates. And crypto leverage is basically juggling knives on a trampoline. Did I miss anything, or are we done scaring everyone responsibly?
That's the responsible amount of fear. 3 money moves for this week. 1. Top up your emergency fund if oil and rates are stressing your cash flow. 2. Rebalance. Don't chase, especially around IPO hype. 3. Reduce high-interest or variable rate debt before you optimize anything else. If this helped your investing and your life, subscribe to BD Daily Finance News Podcast and share it with one friend who doom scrolls markets.